Hi, I'm Adrian Saville. I'm Chief Executive at Cannon Asset Managers. A question that's been put increasingly to us by our clients in recent times is, should I not just allocate my capital to the United States and go USA versus SA? This question makes, I guess, very obvious sense if you consider the South African economic landscape. 2018, we went into recession. 2019, the economy has been in stop-start action. We've got Cyril Ramaphosa very slow out the blocks, rising strain on the fiscus, and real concerns around what I would venture is one of the primary risks facing the South African economy, Eskom. This is translated into a tough landscape for investors. Over the past 3 years, the Johannesburg Stock Exchange headline index has generated a return of 5% per annum versus the typical 15% per annum. And the property sector, for a long time a darling of investors, has generated minus 4% per annum versus the long-term average of 12% per annum. Over the same period, the United States has powered ahead with the S&P 500, capturing ever-increasing highs, and for local investors translated into a weaker rand, this really has resulted in US returns, you'll forgive the pun, trumping South African returns. Against that backdrop, one might venture that this is a no-brainer. Simply allocate your capital to the United States and be done. We would venture that there is pause for thought here, and at least two main reasons. The first is that the economic and political landscape is in shape-shifting territory. The second is that South African valuations, notwithstanding our tough landscape, make for compelling reading. In terms of economic and political shape-shifting, certainly Ramaphosa was slow out the blocks, but Tito Mbowene's 77-pager, the imminent Eskom recovery plan, release on visa restrictions, spectrum that will come to market through late 2019 and 2020, all of these start to add to modest but important catalysts for industrial and business recovery. When we look at the economic data, gross domestic fixed investment growth is at a 5-year high. Lending from banks into home loans is at a 10-year high. And recently released World Competitiveness Index shows South Africa gaining 9 places. Amongst cynics and in a very dark landscape, this good news or these brighter lights are very often lost in the narrative. If we add those pieces of anecdotal evidence together, our strong suspicion is that 2020 is a much better economic landscape than 2019. That will translate into improved corporate earnings, and those earnings are going to be put up against absolutely compelling valuations. The last time the Johannesburg Stock Exchange was on these types of valuations was during the global financial crisis. Our forward price earnings multiple is 11 times, our dividend yield is 5%. By contrast, the United States, which has powered ahead on the back of stimulus that is no longer available, in particular tax cuts, is sitting at 25 times earnings. So the USA, strong economy, artificial stimulus, very elevated earnings. South Africa, tough landscape, no stimulus, deeply depressed valuation, but a slightly brighter landscape faces us. When we look at individual companies, we start to get a real sense of the rubber hitting the road, what that might mean for investors. Examples include, amongst others, the corporate action for Clover. PepsiCo saw the allocation of global capital to buy into Pioneer Foods at a 50% premium for the South African company. Elsewhere, we've seen investor appetite for Metrofile, the document storage business, and where it hasn't been external capital buying into companies, what's really caught our attention is companies' internal capital buying back and cancelling their own shares. A great case in point is Adapt IT, which recently released results announcing that they had bought back and cancelled 10% of their own shares. In this mid and small cap space, another really interesting piece of sort of anecdotal business strength comes from a small company that Canon has been invested in for a number of years, Indequity, in the insurance sector, which announced an earnings update that will see them print 20% growth in earnings at their next set of results. Read together, we see compelling valuations in South Africa, a better, not spectacular, but a better 2020, and that is up against a backdrop of very lofty valuations globally, with an absence of stimulus and capacity for earnings growth. This is not an all or nothing argument. This is not, well, then bring all of your capital from the United States and allocate to South Africa. But certainly for the question, should I not just take my capital from SA and allocate to USA? Our evidence, our arguments, the South African corporate valuations suggests hang on to that thought and allocate some of that capital to SA. When the South African market sits on these types of valuations historically, we've experienced over the next 3 years in the order of 20 and 30% per annum returns in risky assets, including equities and property. If that isn't compelling, if that isn't pause for thought, we're going to be hard pressed to find more interesting or compelling arguments.